With world-class expertise and local insight, Dexus creates value not just for today, but long into tomorrow.
From Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
G'day and welcome to the COB on this Tuesday. I'm Andrew Gagan. Great you can join us as we unpack the day. Now, on any other day, this would be quite remarkable given what's seen on the market. But of course, it's all in context of what we saw yesterday, given the sharp sell-off. We are finishing up around 2% on the local market. Let's just, there we go. We can see the CBO 200, similar moves there on the ASX 200 with tech and energy leading the moves higher there at the moment. Every sector in the green, as you would expect, given those moves. Let's get to the themes of the day. Buying the dip, well, potentially. Always impossible to time the market, is it not? But certainly given also the market higher on what we've seen in terms of futures in the States. Jumbo cuts ahead. Well, potentially, some economists now forecasting that we're going to get a 50 basis point cut at the RBA's next meeting, given the threat that Trump's tariffs pose to growth and confidence, consumer confidence. We've got the latest read today from Westpac and the Melbourne Institute. That has crashed. It was down 6%. So clearly consumers concerned about what they're seeing more globally at the moment and how that's going to impact their own hip pocket. Let's check those sectors at the moment around the traps. As I mentioned, some of those leaders there. Energy certainly moving high. That was one of the hardest hit yesterday as the oil price continues to tumble. The miners also doing well. I was mentioning earlier there with the subsector of gold particularly strong today. And elsewhere, tech. We saw a bit of a mixed move on tech with large tech stocks on Wall Street overnight. But certainly WiseTech and Tech One as one of the best movers there, along with Zip, and also the banks. More muted moves there among the large financials, with Macquarie Group pick of the bunch. In fact, Macquarie was the best of the bunch yesterday as well. Wasn't terribly hard hit. And well, there's the gold price. I mentioned it, how that has moved in terms of those stocks today, but the gold price has come off over the past couple of sessions. All right, just a quick check of what we're seeing in corporate-wise. Star Group has received a lifeline of $300 million from American casino Bally's. The Australian casino will receive the financing through a multi-tranche convertible note and subordinated debt instrument, with $100 million expected before the 9th of April. That's tomorrow. Cochlear says it will continue to be exempt of the tariffs under the duty-free importation policy of the US, which applies on hearing implants. Guzman & Gomez has announced a dividend policy after reporting solid third quarter numbers. Total network sales there up more than 23% in the quarter. And Zip has announced an on-market share buyback of up to $50 million of ordinary shares to commence on the 23rd of April over a period of 12 months. Let's unpack what we are seeing on the market at the moment. Welcome Martin Crabb from Shaw & Partners. Martin, welcome.
Thanks, Andrew.
You've worn your green tie, you pointed out today, so that's obviously worked wonders for the local market.
Green on the screen.
Green on the screen compared with what we saw yesterday, which, not overstating, was a bloodbath, wasn't it? So, what are we seeing? Why is it moving higher today? What are investors seeing out there?
Yeah, I think everyone's looking at the fake news rally that we saw in the Open in the US, where a quote was attributed to the White House that they may pause the tariffs for 90 days, which was quickly refuted. But when that hit the wires, the Nasdaq rallied 10% in like 20 seconds, and then it was like, okay, that's fake news. He didn't actually say that. He said the president will decide what the president will decide. He didn't say the president will pause tariffs for 90 days or even consider it. So I think that just tells you that the market's coiled for a rally. So the Aussie market's obviously taken that to heart to say, well, okay, it feels like this market's oversold and it wants to rally. So some of the things we've been running with is, when you have very high volatility like we've had, and the VIX actually traded even higher just because the market was whipsawing so much last night. So the VIX is up to 47. Typically when the VIX gets above 40, as long as you can ride out the bumps along the way, you typically make good returns. In fact, the average return from the S&P 500 total return over the 12 months when the VIX is above 40 is 35%, Andrew. So
we'll see if we can get that chart out actually of the VIX, just illustrating what we're seeing in the volatility.
Yeah. I mean, it has been as high as 80. It was 80 during COVID. It was 80 during the GFC. So it does get higher than this. But typically anything above 40 or even 50, investors tend to do quite well out of it. It's just it's a gauge of fear, and there's a cliched phrase, but I think Warren Buffett has said, be fearful when others are greedy and greedy when others are fearful. And how do you know other people are fearful? Well, the volatility index is just a measure of that. There's other measures of bearish sentiment and things like that. So typically when you're willing to step in when everyone's fearful, you tend to do reasonably well.
So hard to work against that herd mentality though, isn't it?
Yeah, that's right. I mean, everyone's fearful for a reason. I mean, this tariff war, it could turn into something incredibly ugly, in which case buying the fear may not be the right strategy. So you kind of got to temper it with some common sense, Andrew.
Well, speaking of fear, certainly that was on the horizon before actually Trump actually announced all those tariffs in the form of stagflation. How real is that now?
Yeah, so one of the things I'm thinking about is how does the market measure stagflation? Because if we do get stagflation, then it's going to be really difficult, Andrew, for Reserve Bank to cut rates or the Fed to cut rates, because just remember, they've got a dual mandate. Yes, they could potentially cut rates if they think there's going to be a real hit to growth. So, you had the economist from Deutsche Bank on before saying maybe they go 50 points. But if we just look at two measures here, one is the terminal Fed funds rate. So it's where the futures market is predicting cash rates will get to. So it's the low point of the futures curve, and that's the red line there. So we have seen some growth scares. When that number gets down below 3, that's the market saying the Fed needs to cut rates below neutral, which is 3.25. So what we're seeing right now is clearly a growth scare. We've got sub 3% terminal Fed funds rate. The other measure is the 10-year bond rate, and that's, I suppose, an indicator of inflation. So we have seen the US 10-year trade up towards 5%. So if I just take the difference between those two and call that the term premium, that is heading up, and that is a sign that maybe people are looking at lower growth and higher inflation, and that's really bad for markets, because it means that just because we've got a weak economy, it means the central banks can't cut rates, Andrew, because they need to fight inflation. We need to go back to the 1970s when we had very high inflation and a very weak economy. What did Paul Volcker do? He put rates up a lot, because they were more concerned about fighting inflation than they were about boosting the economy. So if we head into that, we have Jerome Powell on hold, and we have a recession in the US, and that's a really bad outlook for markets.
What about here in Australia, though? As I was mentioning there, our forecast perhaps we are going to get a supersized cut next meeting.
Yeah, so that would be the Reserve Bank saying, look, we're really worried about the global economy, and we're going to cut rates preemptively. That's highly unlikely. I don't think Governor Bullock's kind of talking like that at all. She's still saying we think inflation's on its way down. But if it's a global tariff war, then maybe we get some cheap goods in Australia, but generally speaking, we might get hit with inflation as well. So inflation might be a global phenomenon, not just a US phenomenon. So I think it's premature to talk about what the RBA is going to do, because they're probably going to need to follow the Fed. Like if the Fed keeps rates high and they cut, then it's got significant implications for the dollar. We'll see a much weaker dollar, which again is inflationary. So this is a really complicated, multi-levered process. I don't think it's easy to say, oh, global growth is going to get hit, therefore the Reserve Bank's going to cut rates. I think that's too simplistic.
Now, Martin, of course, when we see these very large falls, there are some investors that hold the nerve and think, well, goody, there's stocks on sale at the moment. What about those ones that are trading at a large discount? Yeah, so we like this naughty corner concept, Andrew. So penned by my former colleague Peter O'Connor in the resources market a few years ago, and we just sort of dusted it off. So stocks that are trading at a discount to their long-term price to book ratio. So we're not looking at PE ratios, which can jump around. We're looking at price to book. So these are stocks that are trading at the low end of their price to book over the last decade. And then we're also looking at stocks that are trading near their 52-week low. So yes, they're cheap, but they're also very, very sold down. So in the ASX 100, we've got IDP Education, Aurora Packaging, Paladin, Ramsay Healthcare, CSL, Pilbara Minerals are all way into the naughty corner. So,
we've got investors that are looking to deploy cash into the market. They're looking at that high volatility level. They're looking at how far the market, how oversold the market is, and they want to put some of their cash to work. These are the sort of stocks that are probably going to rebound. So, typically they come out of the naughty corner pretty quickly. Quality companies like CSL, and even IDP Education, that's being knocked around by the student numbers. But these stocks are probably going to be ones that bounce pretty hard if there's a recovery in the market.
Great, you can identify those stocks. More broadly, given that volatility is likely to increase, given we just don't know what Trump is going to do next, and potentially we're going to see a escalation of particularly that trade war between the United States and China.
Yeah.
What would we be looking for as a buy signal?
Yeah, that's a really good question. I mean, I think it's, an escalate to de-escalate strategy becomes clear. So it's clear that what Trump's doing is not policy, it's strategy. And we start to see some of these deals coming through. So, for example, last night that, okay, we're going to go on pause for 90 days while everyone comes back and negotiates with us. It's like, this is clearly Trump playing a game of chess. It's not necessarily a hard policy. One of my colleagues said to me, this is not like the GFC. One person can change this. One person can just go, I was just kidding on tariffs, everyone, and we avoided GFC. So it's not sort of in that camp of, the banking system collapsing or anything like that. So I think we just need to be a little bit careful with that. But that would be a sign to me, and probably others, that this is strategy. And if he starts being accommodating towards those countries that have come to him and say, hey, we want to do a deal. So we've had apparently 50 countries have telephoned him saying, we want to do a deal. If he starts doing deals, then we should see a recovery in the market. But at the moment, I think you're better off being cautious. Our narrative is don't be brave, be selective. So maybe there's some opportunities in oversold stocks here and there. Maybe it's a good time to diversify your portfolio. If you're too concentrated in equities, maybe it's time to look at alternatives and other things. But I think it's about being selective, not necessarily being a hero.
Martin, terrific stuff. Who knows what we'll be talking about this time next week? It's moving so quickly. Thanks for joining us, Insurance Partners. Let's now move to our stock of the day. And this week, we've been looking at those stocks that you could buy amidst the market meltdowns. We caught up with Rudy Philipp van Dijk from FN Arena and Philip Pepe from Insurance Partners.
Acrow company I cover, I've got a buy rating on it. It's exposed to over $185 billion worth of infrastructure projects across the country, different government agencies, different sectors. It has a potential revenue pool somewhere between $2 and $9 billion over the next 7 years. Infrastructure will get built. One I call out as the Olympic Games, $7 billion to be spent on new stadiums and supporting infrastructure. That will be spent before the Olympics begin. There is no negotiation, that will be spent. So Acrow provides services to that segment, support structures, formwork, etc.
I would push forward Woolworths. Woolworths today is falling because we're on a risk-on day. When we go into a risk-off situation, you want to have Woolworths in your portfolio. It's a different scenario where this is going to be resolved over time, not too long. We're not going to have a recession. And we're not going to have too much troubles with inflation and with bond yields. By all means, the technology stocks, the quality technology stocks we have, they look absolutely great value when they sell off. My favorite, of course, is Technology One. No exposure directly to the US, and a retention rate in customers of 99 point something percent. But hasty to say, they can still face some trouble if derating is still on the agenda.
All right, well, let's check back in on the market, see how we're finishing up. In fact, we'll go to those leaders today. Made a comeback strongly, certainly in the uranium space, led by Boss Energy, also some of those tech stocks, Block, Life 360, and Whitehaven and Mesoblast also on that list. On the negative side of the ledger, HMC's capital has come off today. Mineral Resources remaining under pressure, along with AMP Bapcor and James Hardie. In the small cap space, Northern Minerals this is all about the rare earths and the potential appetite there, given China now has these export controls in place. So Northern Minerals certainly benefiting, up 19%. Terramin, Centaurus Metals also benefiting, along with Strike and Barclay Energia. Negatively in the small cap space, Maya Resources, Zeotech and SmartPay among those to lose out. A quick check of what we're going to see overnight. We've got the Small Business Optimism Index in the States expected to deteriorate further in March over concerns about those tariffs, of course. And tomorrow we do get a decision from the RBNZ, expected to cut rates. The US FOMC meeting minutes will be revealed as well. It's going to be a quiet one at home data-wise. Well, perhaps we need a bit of a quiet day, but who knows what it holds on the market tomorrow. Let's recap where we're finished. We've accelerated into the close. The COB finishing up 2%. Checking in on the ASX 200, up 2.25%, with sector gains across the board there. So a very impressive day, but of course that is relative given the sharp falls we saw yesterday. That is the COB. Thanks for joining us.